Why the limited is dead in 2026. For years, the limited company has been the obvious choice. Low salary, dividends on top. Everyone felt quite clever. In 2026, that advantage is looking tired. In this video, I'll give you 3 clear reasons why a limited is no longer the great option it once was, and one specific case where it still makes sense. Let's start with dividends. The dividend allowance is £500, which now barely covers a modest supermarket trip. Before, dividend tax rates were 8.75% for basic rate taxpayers, 33.75% for higher rate taxpayers. From the 6th of April 2026, they become 10.75%. Basic rate 35.75% higher rate. Now a simple one-person limited example. You take a small salary, around £12,570, and want another £10,000 from the company. As dividends, you'll hand over roughly £3,400 in tax if you're higher rate. Not cheap, just slightly less painful than salary. Take the same £10,000 as salary, and once income tax and national insurance are included, you lose around £4,500. So yes, dividends are still cheaper, but the gap is now small, unimpressive, and shrinking. Add corporation tax, admin, accountants and paperwork, and the limited stops looking clever. It just looks complicated. In 2026, a limited isn't a tax strategy. It's a business decision, and often not the best one. The second reason a limited makes less sense in 2026 is simple. It now costs money just to exist. Digital incorporation now costs £50. No trading, no clients, just vibes and a receipt. Then there's the confirmation statement. That's £34 every single year to confirm that yes, the company is still there and still not doing much. These fees are compulsory. 0 turnover? Pay anyway. 0 profit? Still pay. 0 motivation? HMRC remains very motivated. That's £84 a year just to stay listed. Now add real life. Even the cheapest accountant for a quiet or dormant limited is £500 to £1,000 a year. Again, before a single pound of profit. Which means in 2026, a limited can cost £600 to £1,100 a year purely for existing politely. This isn't tax. This is admin. A limited is no longer something you keep open just in case. It's a subscription, and you don't even get a free trial. Let's compare a sole trader versus a one-person limited on £45,000 a year. Same income, same work. 2 very different experiences. As a sole trader, after the personal allowance, you'll pay income tax and national insurance of roughly £9,000. That leaves about £36,000 take home. No corporation tax, no dividends, no explaining to yourself why you need an accountant to pay yourself your own money. Simple, predictable, slightly dull, which is exactly what you want with tax. Now, the one-person limited company. First, the company pays corporation tax. On £45,000, that's about £8,500 gone immediately. You're left with roughly £36,500 inside the company. You take a small salary, usually around £12,570, and the rest as dividends. Under the 2026 dividend tax rates, you'll pay roughly £2,500 in dividend tax. Your personal take-home? About £34,000. That's already £2,000 less than the sole trader. And we still haven't paid for compliance. Add £800 to £1,200 a year for accountants, filings and payroll, plus company's house fees, and the gap widens further. Same £45,000. More structure, more admin, less money. At this level, the limited looks professional, while the sole trader quietly keeps more cash and sleeps better. Just to balance things out, this isn't a campaign against limited companies. For the right people, a limited is still a very sensible tool. Limited liability matters if your work involves contracts, risk, or the occasional email that starts with "we need to talk." Reinvesting profits still works if you don't need to take everything out immediately. Timing control helps when income arrives in waves rather than politely every month. Some clients also expect a limited company. Not because it's better, just because it looks reassuring on an invoice. And at higher income levels, a limited can still make sense. But now it requires maths, not optimism. Despite everything we've covered, a limited still has one meaningful advantage: retaining profit. On £45,000, a sole trader is taxed on the entire amount immediately, whether the money is needed or not. No pause button, no "I'll decide next year." With a limited, you have a choice. You can take a modest salary, some dividends, and leave the rest inside the business. In this example, around £16,200 stays in the company, already through corporation tax, but not personally taxed yet. That money is available for reinvestment when you decide, not just because the tax year has ended. That's where a limited still makes sense. Not for day-to-day spending, not for convenience, but for control. A sole trader can't do that, and limited company can. And that, more than dividends, is the real remaining advantage. If this was useful, subscribe. If it wasn't, subscribe anyway. See you in the next one.